Hey guys, Marcel LeBlanc here, Certified Financial Planner, and today I'd like to talk to you guys about probabilities and how that relates to insurance, and in that sense that you really do get what you pay for when it comes to insurance. I'll start off by using the example that a lot of people have come across is insurance companies coming to them and saying, hey, you can get a whole lot of accidental death benefits, so accidental death insurance for like dollars a month. So like way cheaper than your typical life insurance policy. So they'll say, hey, I will offer you $100,000 of accidental death benefit for $2 a month. And people look at that and say like, oh, that's a good deal. Well, it's not a good deal because the likeliness of dying from an accident, so not from an illness and not from natural causes, is really, really, really low. The likeliness of that happening is slim to none, and that's reflected in the price of the insurance being offered. So if you take that logic and you apply it to other insurances, critical illness insurance and long-term disability insurance are relatively more expensive on a pure payment basis than, let's say, life insurance. Let's take a 35-year-old. The other insurances that related to health and illnesses, like the critical illness and the long-term disability, are more expensive than the life insurance because the odds of a 35-year-old dying prematurely is fairly unlikely, and that reflects on the life insurance price, which is pretty inexpensive. But the health and the critical illness will, in comparison to the life insurance, seem much more expensive. Well, that's because the likeliness of a claim is much, much, much greater. 3 to 4 times greater. The younger you are, the more probable that the health issues come up before premature death. And that's reflected in your insurance prices. Therefore, you really do get what you pay for. So what I'm getting at is if the financial risk is real, and we can all put ourselves in the shoes of being disabled for life or having to deal with a pretty significant illness such as battling cancer, a severe heart attack, absence from work, that would be pretty detrimental to your finances. Things wouldn't go as expected. Bills would probably be hard to pay. So the risk is real, and the likeliness is 2, 3, or 4 times more likely, so that is reflected in the price. So if the risk is real, you shouldn't necessarily shy away from those products just because you're young. The younger you are, the healthier you are, the more likely you are to survive such health events. Meaning, instead of having a claim on your life insurance side, you've survived the health event, the critical illness, the disability, whatever it may be, and you will be stuck holding the bill financially for whatever event or the costs that incurred over the following years. So, when it comes to financial stability, it is important to consider all angles and consider the likeliness of any event, and remember that you get what you pay for when it comes to insurance. If you have any questions regarding insurance or financial planning in general, visit marcelleblanc.ca. Remember, my advice is free, and always will be. Cheers, guys.